In 1397 in Florence, a man named Giovanni de' Medici founded a bank that would reshape Europe. At first, nothing about it seemed revolutionary. Banks already existed and merchants traded across borders. But what Giovanni understood was something deeper, not about money itself, but about how money moved. The real limitation of medieval Europe was not wealth. It was the movement of wealth across distance. Transporting gold was slow, dangerous, and unpredictable, with constant exposure to theft, war, and loss. A merchant could lose everything not through bad decisions, but because the system itself was fragile. This created a ceiling on economic growth where trade could not scale beyond certain natural limits. What the Medici built was not just a bank, but a system designed to remove that limitation entirely. Instead of moving gold physically, they moved trust through structured financial instruments. A merchant in Florence could deposit money and receive a letter of credit backed by the Medici. That document could then be used in cities like Bruges or London without moving any gold, no transport, no protection, no delay, just financial value. Moving through reliable information today, this seems obvious, but at the time it fundamentally changed how commerce worked. It reduced risk, increased speed, and allowed trade to expand far beyond local markets. And once trade begins to scale, everything built on top of it begins to scale as well. But the real genius of the Medici was not just the idea, it was the system they built around it. They created a network of branches across Europe in the most important commercial cities: Rome, Venice, Geneva, Bruges, London, all connected financially back to Florence. Each branch operated locally, but remained integrated into a single coordinated structure. This created one of the first international banking networks in recorded history. For the first time, a bank could operate across regions. While functioning as one entity, what we now call a multinational corporation was already emerging inside this system. At the center of this system was not gold, silver, or physical assets, but information. Because once money stops moving physically, records become more important than metal. And this is where the Medici introduced a critical innovation that changed finance forever: double-entry bookkeeping. Every transaction recorded twice, once as a debit and once as a credit for balance. This created internal control, accuracy, and a clear view of financial reality at all times. For the first time, a bank could understand its true position without uncertainty. Profits, losses, exposure, and risk became visible, measurable, and manageable. This was not just accounting, it was control over complexity at scale. Banks before this struggled to grow because expansion destroyed visibility and order. The Medici solved that problem and made large-scale finance possible. They could expand across cities without losing control of operations, and that allowed them to make faster, better, and more informed decisions, because once you can measure money precisely, you can manage it effectively. And once you manage it effectively, you can multiply it consistently. The Medici became more than participants. They became the infrastructure of the economy. Merchants relied on them, nobles borrowed from them, and institutions trusted them, and slowly power began to concentrate around their financial system, not through military force, not through formal titles, but through dependency. This is the moment when banking transforms from service into leverage, because if enough people depend on your system, you effectively control the system, and the Medici understood this earlier than anyone else in Europe. But there was one institution more powerful than any bank, city, or noble family: the Catholic Church. It controlled wealth across Europe, collected revenue, and influenced millions of people. But despite that power, it lacked an efficient and modern financial system. Its money was spread across regions, but its control over that money was limited, and that gap became the greatest opportunity in the rise of the Medici, because when the most powerful institution depends on your financial system, you do not just become wealthy, you become structurally indispensable. And that is exactly what the Medici were about to become. But becoming indispensable to merchants was only the beginning of the Medici story. The real turning point came when they connected their system to the most powerful institution in Europe, the Catholic Church. In the 15th century, the Church was not just a religious authority, it was a financial giant. It collected taxes across kingdoms, managed vast land holdings, and moved money across the entire continent. But it had one critical weakness: its financial system was inefficient, fragmented, and difficult to control. Money flowed in from everywhere, but managing that flow was slow, inconsistent, and risky. And this is where the Medici stepped in with a solution that changed their position forever. They became the bankers of the papacy. This meant they handled the church's revenue, processed its payments, and managed its accounts across Europe. Every tithe, every donation, every transfer passed through a system they controlled, and with every transaction they earned not just money but influence. Because controlling financial flow means understanding where power actually sits. The Medici were no longer just serving the church, they were becoming part of its infrastructure, and once you are inside the system, you begin to shape it. This relationship created a powerful feedback loop. The church trusted the Medici with its money. The Medici used that position to expand their reach, and that reach reinforced the church's dependence on them. But here is where the story becomes more interesting. What happens when a private banking family becomes essential to a global religious power? The answer is influence without visibility. The Medici did not need armies, they did not need official titles. They had something far more effective: control over credit. In a system where almost everyone depends on borrowing and liquidity, whoever controls credit controls outcomes. In 1434, Cosimo de' Medici took control of Florence. Not as a king, not as a dictator, but as a banker. He controlled who received loans. He controlled who lost funding. He controlled who survived financially. Political allies found support. Rivals found themselves cut off. Decisions that looked political were often financial at their core. This was power without formal power, and it worked. Florence became effectively governed by the Medici, even when they held no official ruling title. But the relationship with the church went even deeper because influence over money eventually became influence over leadership. The Medici family would go on to produce multiple popes, men who rose through the church with financial backing behind them. This created something unprecedented. The same family was now influencing both the financial system and the spiritual authority of Europe, and that level of integration changes everything, because when money and belief begin to align under the same network, power becomes self-reinforcing. But there is an important question here. Was this sustainable, or was it building something too complex to last? Because systems built on influence and dependency grow fast, but they also become fragile in ways that are not always visible. And while the Medici were expanding their reach, they were also expanding their risk. While the Medici were consolidating financial and political power, something else was taking shape in Florence. It did not look like finance at first glance, and yet it was completely dependent on it. The Renaissance. But the Renaissance was not just an artistic explosion, it was the result of capital being deployed in a new way. Art, architecture, science, and philosophy do not emerge without stability, time, and sustained funding. And in 15th century Europe, very few institutions had the ability to provide all three consistently. The Medici did. They had liquidity, they had networks, and most importantly, they had control over capital flows. But here is the key point. They did not just accumulate wealth. They decided where that wealth would go, and that decision shaped history. They financed artists not randomly, but strategically, choosing projects that elevated Florence. They supported architects who redesigned the physical space of the city into something symbolic. They funded scholars and thinkers who expanded knowledge and influenced future generations, and slowly Florence transformed, not just into a rich city, but into the cultural center of Europe. This was not accidental, it was engineered, because the Medici understood something most financial powers do not realize until much later. Wealth alone does not create lasting influence. Perception does. If people see you as powerful, you gain authority. If people admire you, you gain legitimacy. And if you control legitimacy, your power becomes self-reinforcing. The Medici used patronage as a tool to shape perception. They invested in beauty, knowledge, and culture to build a narrative around their power, and that narrative made their position stronger than money alone ever could. Think about it, a bank can lose money, a reputation can sustain power even during loss. This is why the Renaissance matters in the story of finance, because it shows how capital can shape not just markets but culture itself. And once culture aligns with power, that power becomes extremely difficult to challenge. But there was a hidden cost to all of this expansion, because while the Medici were funding art and culture, their financial system was becoming more complex. More branches, more clients, more exposure, more moving parts that needed coordination, and complexity introduces a different kind of risk. Not visible from the outside, but dangerous from within. The more the system expanded, the more it depended on perfect management, and perfect management rarely lasts across generations at the same time. The Medici were taking on larger and more influential clients. Rulers, nobles, institutions that required massive amounts of credit, and these relationships were not purely financial, they were political, which meant risk was no longer just economic, it was systemic. If one major borrower failed, the impact would not stay contained, it would spread, and this is where the story begins to shift, because the same system that allowed the Medici to rise was now exposing them to a level of risk they could not fully control, and the question becomes unavoidable. What happens when a financial empire grows faster than its ability to manage itself? History gives a very consistent answer: it works until it doesn't. By the late 15th century, the Medici Bank had reached a level of dominance unmatched in Europe. It controlled financial flows across multiple cities and influenced both political and religious institutions. On the surface, it appeared stable, powerful, and untouchable. But beneath that surface, the structure had begun to weaken, not because of one single mistake, but because of a pattern that repeats in every financial empire: overextension. The Medici had expanded aggressively across Europe, opening branches, managing capital, and extending credit at increasing scale. And with that scale came a shift in the type of clients they served, from merchants and traders to kings, nobles, and ruling powers. And this is where risk fundamentally changes. Because lending to powerful people is not the same as lending to ordinary clients. Powerful borrowers are harder to control, harder to pressure, and sometimes impossible to collect from. The Medici extended large loans to ruling figures, including the English crown at the time. These loans seemed strategic, strengthening alliances and influence. But when repayment became uncertain, the losses began to accumulate quietly, and this is how financial collapses often begin. Not with a sudden shock, but with slow, invisible deterioration. At the same time, internal discipline within the bank started to decline. The later generations of the Medici did not maintain the same level of control. Branch managers operated with more autonomy. Risk management became less strict, and financial reporting lost the precision that once defined the system. Transparency began to fade, and when transparency fades, risk increases. But the most dangerous part is that the system still appears stable until it suddenly isn't. This is the illusion of large financial structures. They look strong right up until the moment they fail. By the early 1490s, the situation had become unsustainable. Losses from unpaid loans combined with weak oversight created systemic instability. Branches began to fail. Confidence began to drop, and once confidence starts to disappear, a bank cannot survive for long. Because banking is not built on money alone, it is built on trust, and trust once broken spreads faster than any financial crisis. By 1494, the Medici Bank had effectively collapsed. Its network unraveled, its influence weakened, and its financial dominance ended, but the consequences went beyond finance. The Medici lost control of Florence. They were expelled from the city they had dominated for decades, and their political power collapsed. Alongside their financial system, what had taken generations to build collapsed in a relatively short period of time. But here is the part that matters most. The system they created did not disappear. It evolved. Double entry bookkeeping continued to spread across Europe. Letters of credit became a standard tool in international trade. Banking networks expanded and became more sophisticated. Other families and institutions adopted the same principles, refined them, scaled them, and built new empires on top of them. Because the Medici did not just create a successful bank, they created a framework, a blueprint for how financial power can be built and scaled. And that blueprint did not end in 1494. It continued through history. From early European banking families to global financial institutions, to modern financial systems that still operate on the same core principles. The names have changed, the scale has increased, the technology has evolved, but the underlying structure remains the same. Because once a system works at that level, it does not disappear, it gets repeated. And every financial empire that came after the Medici in one way or another is still operating inside the system they created.